Welcome to Trading Day. I'm Roger Peterson. Thanks very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Shares of TransAlta are up today after the power generation company signed a deal with Puget Sound Energy to switch its power plant in Washington from coal to natural gas. The long-term deal is expected to begin at the end of the year. Calgary-based TransAlta says it will take about $600 million to extend operations and switch from coal to natural gas. The company expects the investment to pay back roughly 5 times its cost. Shares of Telesat and MDA Space are climbing today. The satellite operator is entering a partnership with the Government of Canada and MDA Space. Telesat will develop and deliver military satellite communications capability to the Canadian Armed Forces. The project will strengthen and safeguard Canada's Arctic sovereignty and bolster the nation's NORAD and NATO commitments. Microsoft will be making a $19 billion AI investment in Canada between 2023 and 2027. So there's more to come over the next couple of years. The tech giant will build new digital and AI infrastructure in Canada with new capacity beginning to come online in the second half of 26. The country will receive more than $7.5 billion over the next 2 years, according to the Logic. The American company is also pledging to protect Canadian data from other governments, including the U.S. And taking a look at the TSX, it is up about 0.44% right now. A lot of that on metals. Silver mining companies doing well right now. Silver topping $60 an ounce at one point. It's nearly doubled in the past year. South of the border, it was an all green a couple hours ago, but that has changed, obviously. And now we're looking at the S&P, almost a wash at 0.1. Dow Jones off by 0.2 almost, and the NASDAQ up by nearly a quarter. And all eyes are on the Federal Reserve as we await a decision on whether the U.S. will see a rate cut or not. We're joined by Nate Tuff, the CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us.
Great to be here.
It's pretty much, are we at about 110% that there'll be a rate cut tomorrow?
I think it's a pretty good certainty that we're going to get a cut tomorrow. The messaging, obviously, as well as expectations going into next year, is what's ultimately going to matter. And I think the market, they priced in the cut now, but I think they're also expecting a bit more of a hawkish tone as it pertains to what's next for the Fed.
What do you think they want to hear?
Well, I think the market has a fairly low bar because, first of all, they're expecting and have priced a cut. And second of all, I think the market is expecting a bit more of a hawkish tone driven by what we've seen in the rates market, particularly further out the curve over the last few weeks. So I think the market will accept pretty much anything as long as it's within that more slightly hawkish to leaning more towards dovish. If it becomes very aggressively hawkish, as in we're basically on hold for longer, that will be problematic for the market. But I think other than that, we're in a pretty good spot from a market perspective.
And for cuts, what would they like to see over the next in 2026?
So we're pricing about 3 additional quarter-point cuts in 2026. I actually think the risk is for more, and a lot of that's going to depend on the makeup of the Fed. So you have what I would define as the pre-Powell era, as the Powell era, and then you have what will be the post-Powell era later next year. The risk is, or the potential benefit, depending on how you want to look at it, is there is more room to go further lower if you end up with a Fed that becomes more comprised of individuals that are more tailored towards a lower interest rate level, which is certainly what the Trump administration would like to see. But also, I think parts of the market would appreciate a lower level of yields as well, which will be driven by the makeup of what the Fed looks like once Powell is no longer chair.
Now, how much of an influence is the president on decisions and the market as well? Because they have to make these decisions based on the numbers they see, but then they also have this external pressure. How do they balance that, whoever the next head of the Fed will be?
Yeah, I know it's an interesting question because the reality is the president and an administration can say what they want, but I truly do believe that the Fed believes they are an independent agency, regardless of who's necessarily in charge, particularly with the candidates that are on the table right now for the next possible chair. They will remain independent. Now, with that said, that doesn't mean the Fed can't align themselves with more of the views and or what should be focused on as it pertains to what drives interest rate cutting or hikes. And if we get a Fed that's much more focused on concerns around growth and concerns around employment and less concerned about inflation, you still have a broader narrative where you can have rates lower than what the current Fed is thinking. And this was predicated on the fact that there are reasonable scenarios where someone could come in and say, we can afford to have a lower general interest rate because we believe the neutral rate is a lower level than what the current Fed believes. And it will still be figured out through the core functions of what the Fed should be focused on versus driven by what others or the president might be saying.
And I want to get on and talk about, we're starting to see data again from south of the border. Is that going to be a factor at all? Anything that we're seeing over the next month, say?
Yeah, the data is still a bit murky, although, as you said, it is starting to get populated again. I think, generally speaking, we are in a period where we're going to see slightly weaker data, particularly when it comes to jobs data, as well as some of the data around housing and even potentially consumers type of things. So that data will generally be supportive in our view of allowing the Fed to continue to cut into 2026. The wild card is still inflation. And we do believe that inflation will remain sticky, but it will not be so problematic that it will cause the Fed to want to pause or outright stop cuts anytime soon. We have an environment where there's a lot of offsets in inflation, particularly as it pertains to housing data, that will keep inflation generally under control in our view, even though it might be slightly elevated relative to Fed expectations.
So is that 3% then? Is that what you're thinking for under
We're
control?
roughly talking about high 2s into basically 3% is comfortable for the Fed, even though it's not at their target levels.
And is that worrisome at all that it hasn't gotten back down to the target levels? They'd love to get it down below 2, right?
Well, they would like to, but I think there's a lot of structural arguments as why we might not get there. And we may be in an environment where we just have to accept that. I mean, the reality is we are going through a cycle where we're getting a bit more deglobalization. Tariffs are on the margin, are inflationary. And we do have some structural drivers in the market right now that are basically keeping inflation slightly elevated. But the reality is, I don't think an inflation level around 3% is particularly problematic. And in fact, in some cases, actually is a positive because you do still have growth in overall costs, and you also likely have growth in wages as well, driven by some of that inflation.
All right, so heading into 2026, what's an investor to do?
Well, we are a bit more cautious next year. And the main reason for that is we've had such a strong risk-on environment for quite some time, including 2026. So we're much more focused on a higher quality next year. We still think there's upside in equities. We still think there's money to be made in the bond market. But we're definitely gravitating by taking some chips off the table with more speculative areas of the market and focusing on high-quality areas, such as healthcare, such as high-quality tech, mid-caps in the United States and globally have much more attractive valuations. And we do expect a bit more broadening in market participation versus just being driven by the Mag 7 that we've seen over the last 12 months.
Okay, we're going to have to wrap it up there, but Nate, thanks as always for joining us.
Thanks for having me.
Nate Tuft is CIO and Senior Portfolio Manager at Manulife Investment Management. Well, Group Dynamite posted record profit and has raised its outlook. Is it the next Aritzia? We'll take a closer look after the break. Group Dynamite shares are soaring today after the company said it delivered unprecedented Q3 results. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay, thanks as always for joining us. Unprecedented.
Unprecedented,
Big
yeah.
Word.
It is a big word, and we're seeing those shares soaring today. Last I checked, it was up 6%, but earlier today up 13%. So this is really big news for the company. This is the clothing retailer behind Dynamite and Garage. So yeah, almost at 7% at the moment. They're saying they're seeing like strong customer turnout, high traffic both in stores and digitally. So when we look at the numbers, comparable store sales up 31%, revenue up 40%. Mostly driven by new stores as well. So they've opened about 8 stores in the U.S. in the last quarter, They touted that they didn't see any new stores opening and that they are not about to close any stores either. They're also looking to expand into the UK over the next year. So this is the first time that they're seeing, expansion out of North America. So really some good news coming from this company.
And their guidance, they're raising it for 2025.
Yeah, so they're raising it for 2025, a sign that they're seeing strength, and they're going to continue to see strength despite, tariffs hitting people quite hard. They say that they're seeing consumers still spending money. They're talking about this kind of K-shaped economy, that they're seeing that K-shaped trend. So they're seeing high-end consumers still spending money, and for that reason, they are raising their guidance. Adjusted EBITDA margin for the full year now between 35 to 37%. That's up from 32 to 33. They're also raising comparable store sales growth guidance, assuming that trade relations between Canada and the U.S. stay solid. And of course, we'll have to wait and see what happens there. But if that happens, raising comparable store sales growth to 25 to 27%. That's up from 17 to 19%. And then, as I mentioned, the company also expecting to open some new stores. They say they've got this goal for fiscal year 2028 to have 350 stores, so open a substantial number of stores and continue to grow, as I mentioned, into the UK and also into the US.
Okay, Lindsay, thank you for that. Lindsay Biscayne for BNN Bloomberg. As Bombardier showcased its newest jet, the company's CEO says he hasn't checked the math on Saab's claim its fighter jets would bring in 10,000 jobs to Canada. CTV's Omar Sachedina filed this report.
Canadian superstar Tom Cochrane headlined the entry into service kickoff for Bombardier's Global 8000, an $83 million U.S. business jet the Canadian company is banking on to become a superstar in the sky.
So this is the fastest airplane that exists on Earth right now, built here in Toronto. We should be very proud of that.
In an exclusive one-on-one with CTV News, Bombardier CEO Éric Martel says the jets have become its bread and butter, propelling its remarkable turnaround for a company that nearly a decade ago received hundreds of millions in government bailout for its C-Series passenger planes, which failed because of cost overruns and technical delays. Now it's extending its reach into defense to build on its success.
Perhaps Bombardier's dreams are greater than its ability to pay for them. You, of course, want a piece of the pie from these billions in government commitments that we saw in the last budget. What do you say to those critics that you're extending your hand too far?
This is a very fair question. And this is something that I think we learned from what happened in the past. It's not like we're designing a jet fighter or something else. We won't do that. But it's what we're doing is we're taking, the existing platform, and we are helping people to integrate their system. The risk for us is very minimal.
The latest potential move is to deepen its 15-year relationship with Saab, which is trying to sell Ottawa on its Gripen fighter jets. The Swedish company says Bombardier would assemble the planes in Canada, creating up to 10,000 jobs.
Which would effectively be doubling your Canadian workforce, because currently you have 12,200. I mean, is that a realistic number?
Yeah, I think when they say 10,000, they probably also look at the whole maintenance after and support and service. The reality is those planes will be built. We'll need X thousands of people probably to build it with the supply chain.
So the number, is it realistic or is it?
I don't know. I haven't checked their number, but they came up. But I'm assuming that it's also including the all aftermarket and support for the next 30 years.
So these 10,000 jobs are not necessarily direct jobs. They could be indirect jobs. Do you think it'll happen?
I don't know. I'm not in the secret in Ottawa, so I know some people are thinking about this very seriously right now.
But obviously, it would be a substantial plus for your company to have this decision be made in Saab's favor. So you could join with them or pair with them.
Absolutely. So we could be, as I said, we've been a partner for a long time.
For now, the primary focus, business jets. Last month, the Canadian government removed a 10% luxury tax on private jets, which is helping. So is the fact that aerospace is mostly exempt from Trump's tariffs.
Actually, it was free trade since 1979, even before NAFTA, and even, of course, before USMCA. So it's a bit of a global agreement that, country can do aerospace parts to other country, and there will be no tariffs.
But as there is talk of USMCA being revisited or reviewed next July, is there concern that perhaps aerospace could be included?
There's always
tariffs?
concern.
Especially for a jet like the Global 8000, which includes parts and assembly from Canada, Mexico, and the United States.
I'm always thinking of Plan B, Plan C, Plan D, but the reality is, as I said earlier, I think common sense will prevail.
Despite the headwinds, for today at least, Bombardier is celebrating. A Canadian plane sold to a Canadian buyer. Billionaire and waste management mogul Patrick Dovigi.
That was CTV's Omar Sachedina. U.S. President Donald Trump is signaling fresh tariffs on the Canadian fertilizer industry. We'll have more on this after the break. Okay, U.S. President Donald Trump now signaling he could impose tariffs on Canadian fertilizer. What does this mean? We're joined by William Pellerin, partner and international trade lawyer at McMillan. And William, thanks as always for joining us.
Happy to be here, Roger.
Okay, so a month ago, the White House said that there would be no reciprocal tariffs on fertilizer. Now we're here and they're mulling it, they're musing about it. What has changed?
Honestly, this is the biggest head scratcher that we've had in quite some time with the U.S. administration. Clearly, the U.S. president is hyper-focused right now on bringing costs down for farmers. One of the ways that they're looking at this is in terms of the farmer supply chain and getting fertilizer costs down. And for that, the objective appears to be to bring to onshore a lot of fertilizer production. The problem is that in the short term or even the medium term, imposing tariffs on Canada as the primary supplier of potash fertilizer is, of course, going to increase costs significantly on U.S. farmers. So we're trying to sort this one out and try to understand it in the broader context, and it may well be one that needs to be dialed back a little bit.
And I mean, they can't meet the potash demand, can they? They simply don't even have it there.
That's correct. I think it would take, by some estimates, 3 to 5 years to even just reduce some of the dependency that they have on Canada with respect to potash.
Is this another shot in the CUSMA negotiations, or is this? Do we even know where this is coming from?
I think it goes to the broader trend of what we're seeing from the United States administration in terms of reshoring supply to make sure that the United States is making absolutely everything that they can in the United States, and seeing everything as kind of a net win for the United States has to be as a loss for other sides, including Canada. We've seen this with autos in particular, where the U.S. has said that the United States is going to make autos and it won't be in Canada. And so this might be something that the U.S. is thinking about also. In this case, however, I think they'd be so far away from moving the needle anytime soon that I think it still plays to Canada's advantage, particularly with U.S. farmers that are really feeling the hit of U.S. tariffs.
And now, if these tariffs actually did go into effect and we started to see a drop here, are there alternate markets for Canada when it comes to potash and other fertilizers we provide to the States?
It's a good question. Not sure that anyone can make up overnight what we ship to the United States, but I think the more important piece there is that even with a very high tariff, I suspect that the answer is that U.S. consumers and U.S. farmers are going to have to absorb it. The U.S. does not seem to have other viable sources. There are other producers of potash globally, whether Russia or others, but ultimately they're going to need the supply for the next foreseeable future before they can even ramp up. And so I think it just ends up being one of those situations where the importer truly bears fully the cost of this tariff. And it just means that the U.S. administration is going to need an even further support package to U.S. farmers. They announced in the last day or so an additional $11 billion U.S. to farmers to compensate them for increased costs caused in part by the trade war. And so this only adds to the confusion if they're going to add additional costs on top of that.
A bigger picture, what can we expect going into 2026? I imagine the talks for CUSMA will start in full, though they probably have been kind of going on, haven't they, with everything that's revolving around here. What can we expect, though, heading into 2026?
I think it's actually sitting down at the table and when those negotiations fully start. CUSMA review is not, in theory, supposed to be a full-fledged renegotiation. We know that. However, we, of course, know that the United States is going to take this opportunity to extract concessions from Mexico and from Canada. I think we're going to see in the coming months an increase in the rhetoric and the threats of pulling out of the USMCA. I think we're going to see the U.S. make demands around manufacturers onshoring back into the United States. We've seen that in a number of other sectors, particularly aggressively, for example, on the pharmaceutical side, and in autos. I think we're going to start seeing quite a bit more suffering from Canadian exporters, particularly in sectors now very hard hit by tariffs like wood products, furniture, kitchen cabinets, and the like, that are really going to amp up the pressure on the federal government to do something here in Canada. So that whole dynamic is really coming to a crux as we move into January and February.
Can you see Ottawa helping out those areas that you feel may be hit, or are they going to have to be wary on how it's perceived south of the border?
I think there is definitely some help that will have to occur. There are tens of thousands of jobs in just wood product manufacturing alone across the country that are we're seeing. Many of them are clients of ours, negative gross margins, already a number of layoffs, trying to avoid layoffs before Christmas, but they're happening anyways. So the federal government's going to have to do something. And then the question is, what does that look like? And can we structure this in a way that doesn't open Canada up for further retaliation against other countries, whether it's the United States or China or others? So I think it's about choosing the tools judiciously and understanding where the threat lies to Canadian manufacturing.
Okay, William, thank you as always for joining us.
My pleasure.
William Pellerin is partner and international trade lawyer at Macmillan. After the break, Bloomberg's mining, steel, and aluminum reporter Jacob Lorick has been watching the Anglo-American shareholders meeting. We'll get the latest after this. Brookfield and the Qatar Investment Authority are teaming up on a $20 billion U.S. venture to invest in AI infrastructure in Qatar and select international markets. The Canadian firm has been among the most active foreign investors in the Gulf in recent years. Last month, Brookfield announced the launch of a $100 billion U.S. global AI infrastructure program in partnership with NVIDIA and the Kuwait Investment Authority. Home Depot shares are down slightly in light of the company's recent predictions. Home Depot forecasting fiscal 2026 comparable sales growth and profit below analysts' estimates as demand for do-it-yourself projects and big-ticket items decreases. U.S. housing demand has also been choppy due to rising unemployment and high home prices. However, Home Depot expects the pressures in housing to correct and provide the home improvement market with support. We're watching shares of NVIDIA today amid U.S. President Donald Trump's endorsement. Trump recently announced that NVIDIA will be allowed to ship its H200 artificial intelligence chips to approved customers in China and elsewhere on the condition that the U.S. gets a 25% cut. Trump says Chinese President Xi Jinping responded positively to the proposal. Semiconductors, which are key components in nearly every category of electronics, are at the center of the AI race between the U.S. and China. And looking at the markets, the TSX is up nearly a half point, being fueled by silver a lot of the way. Silver mining companies are doing well as silver floats around record highs at or above $60 US an ounce. South of the border, it's a mixed bag down there. You can see the S&P 500 up by a little more than 0.1%. Dow Jones down by 0.2, say, and the NASDAQ Composite up by nearly 0.3. Well, Anglo-American and Teck Resources are holding shareholder votes at special meetings in London and Vancouver today on the M&A deal to create a $50 billion global metals giant. For the latest, we're joined by Bloomberg's mining, steel, and aluminum reporter, Jacob Lork. I gave you an extra title there, Jacob, but thanks for joining us. The Anglo meeting's happening right now in London. What do we know? Where are we at with that?
That's right. So we're expecting a press release from Anglo American at any point now, indicating whether the vote has been approved or not, if shareholders are in favor of it. After that, Teck is supposed to do the same thing, and widely it's believed that shareholders are going to support this deal.
What's giving that indicator that they're going to say yes?
Well, so far we just haven't heard much pushback. Around this time a couple of years ago, Teck was looking at a split up of its assets, and they received lots of pushback quite vocally from some of their top shareholders. And this time it's been quiet.
And was the factor about the bosses getting those millions in bonuses and they rolled it back yesterday, was that an issue at all?
Mildly, but not one that's enough to derail the deal. We saw, I think it was ISS that came out and said that they would recommend shareholders vote against that part of the deal. But broadly, they've supported it as well.
They've supported it. And now the meeting in Vancouver is coming up at 2 p.m. Is the vote supposed to be held almost simultaneously or as close as possible?
That's right. It's all expected to happen at roughly the same time.
And then if we get a yes from both sides, what unfolds? And what do we need for a yes? What percentage?
Ultimately, it's 2/3 for both Anglo-American voters and for Teck voters. And so once that goes through, Teck has sort of two portions of its vote. They're the Class A voters and the Class B voters. For both of them, they need 2/3 approval.
And if by chance there would be and then if that happens, then what are we looking at? How long will the process take for the merger?
From there, we're expecting about a year before it's supposed to close. The next thing that Teck and Anglo have to do is they have to go to regulators. There are about 8 of them across 8 or 9 countries that will be indicating whether they're going to support the deal. Teck and Anglo have both focused on Canada in specific. They want to get the support from Mark Carney's government, which has indicated before that they want to see a little bit more from the two companies in order to support the deal. They want to see more employees in their Vancouver headquarters. But from what we've heard, it sounds like that's moving along pretty smoothly, and we should see an approval from them in the near future.
And with that, do we know what the company will be called, the new company? And it will trade in London, or will it trade
Teck Anglo.
Teck Anglo. And where will it trade?
It looks like it'll trade in London with a secondary listing in Toronto.
Okay. And all right, we're going to wrap it up there. Hopefully we'll get those results soon. But Jacob, thank you for that update.
Thanks.
Bloomberg's Jacob Lork. Air Transat pilots are primed to walk off the job as early as tomorrow morning after the union issued a 3-day strike notice. CTV's Heather Wright has this report.
Checking in with some extra uncertainty.
A little bit nervous, but I'm hoping everything will be okay and we'll be home next Monday.
The union representing Air Transat's pilots has issued a 72-hour strike notice. Pilots poised to walk off the job early Wednesday morning if an agreement is not reached.
I mean, it is what it is. I mean, there's not really much we can do about it.
In anticipation of a strike, Air Transat has begun bringing its passengers back home, adding 4 more flights today with more planned for Tuesday. So far, no flights have been canceled, but the airline is trying to get its fleet back in Canada before the strike deadline. The two sides have been in negotiations for nearly a year, and experts say the timing of this strike notice is no accident.
They're doing this because this is the period of time where Transat is making its most money. It's the busiest time of the year for Transat. Planes are full, fares are high.
Negotiations continue with ALPA, the Airline Pilots Association that represents the roughly 700 Air Transat pilots, saying in a statement, while some progress has been made, there is still work to do. We are working tirelessly to reach an agreement that achieves the collective priorities of our group. Air Transat says it has offered its pilots wage increases of 59% over the next 5 years, a number the union has called creative accounting. The union's demands are considered unreasonable, and its premature actions carry serious consequences for customers, the company, and its 4,300 other employees. Air Transat has struggled financially over the last several years and has not turned an annual profit since 2018.
Asked last week if the federal government would intervene in the event of a pilot strike, Jobs Minister Patty Hajdu declined to answer, calling the question hypothetical. Ottawa did get involved in the Air Canada flight attendant strike back in August, a back-to-work order the union ignored.
And that was CTV's Heather Wright. Well, PepsiCo is cutting jobs and phasing out some products as part of a deal with an activist investor. We'll take a deeper dive after the break. PepsiCo has reached an agreement with activist investor Elliott Investment Management that includes a 20% reduction in its U.S. product lineup. The soda and snacks company also plans layoffs as part of cost reduction efforts. For more, we were joined earlier by Dan Rohinton, portfolio manager at IA Global Asset Management.
This tends to follow the activist and the consumer staples cycle in some ways, but I think it's also a reflection of where we are as a whole. So what the normal cycle is, you go through these high growth periods, and this for Pepsi would have been decades ago at this point, but you go through this big top line acceleration, you scoop up all these different brands, then you go through the financial engineering where you move your bottling operations around, do some special dividends, do some basic financial engineering being, let's strip this cash flow here, let's outsource this. And then finally you hit the stage where, okay, the activists step in and then more sweeping changes need to be made. I'd argue this is probably a long time coming for Pepsi, and the changes will be painful, because when they say they're making changes, that means layoffs. And in this case, some decently sweeping ones, I would imagine, on top of the fact that you're also going to see, call it portfolio optimization, which in this case means selling off things like SodaStream. They have sparkling lime. They have all these brands that are not named Pepsi or Doritos. And remember, Pepsi is not just a carbonated beverage company that owns Poppy beverages and Pepsi Cola. They own Frito-Lay, which makes Doritos and all kinds of different chips and salty snacks. Both sides of the businesses are under some strain, and they're going to make some pretty significant changes to try to get the ship back on track.
Well, they were talking about putting protein and fiber, adding protein, which is all the rage right now with foods, is adding the protein, but even fiber, I believe, in things like that. Are they chasing, or are they going to be ahead of the...
That's pretty normal. You know, consumer staples companies, they change. They take, what was it? The Greek yogurt was a big thing, and then suddenly everyone's got Greek yogurt.
I love my Greek yogurt.
And there's nothing wrong with Greek yogurt, but now that you're putting protein in your chips to go with your saturated fats, that's the go-to trend now. So are they responsive as a company? Sure, but that's the marketing department's job. But structurally, are people moving away from these types of products? I'd say that's probably a bit oversold. I think the real story with consumer staples, and Pepsi is absolutely part of this discussion, is they just took too much price during COVID, and they leaned on price as a substitute for volume. And that's just to try to financially engineer your top line higher. Now you're at the stage where consumers are balking at the fact that
things are expensive.
Things are expensive, and the branded companies are losing share to private label, and consumers are just substituting away to cheaper products that are not these types of snacks. So I think all these things are coming at Pepsi at the same time, but I would say these trends were all building. It's just that this is the biggest company for this to happen to.
And do you think Pepsi can do it? The pressure, like what Elliott's pushing for? I mean, they're cutting product line, but they'll want everything else. Is that possible? Is there room for it?
I think there's room for it. The question is, on the other side of this, do you see a demonstrably different company? I would say probably not. Just ask Unilever. You know, they went through activists. They went through a lot of changes. Go talk about Nestle. So consumer staples tends to be the sector you trade because in general, all these large branded companies are losing mind share and market share a few years after that. And consumers are just moving on to different things. And this treadmill is pretty fast for them to keep up on. So and I think, let me just unpack that comment because I think it's an important one. In the 1950s, 60s, 70s, all the way to the 2000s, so the end of the newspaper era, you could be Oreo, and you could blanket America, you could blanket Canada, and everyone knew the best cookie in the world was an Oreo or Chips Ahoy or whatever Mondelez wanted you to think at the time. Or sorry, it was RJR Nabisco back then. Now if you're a small startup, you can advertise some ultra niche product on Facebook or any of the other social media platforms, and you can get some scale. You won't be Oreo, but you'll have a chance to fight for it.
Yeah.
So that fundamentally breaks what is the umbrella portfolio company consumer staple moat. And this is just the 10, 20-year lagged effect of that, and just happening to one of the biggest consumer staples companies in the world.
And to companies like that, do they need those activist investors?
Kind of, because you need someone to ultimately blame. So does the management at Pepsi realize they're probably overstaffed, which they probably are? Are they extended on different brands? They can't put enough budget for individual products or individual strategies? I'm sure they knew all that, but they need a nice boogeyman to say we were forced into it.
Yeah, and that's
so. That's Elliot's job.
And sounds like Elliot likes to do that because that name pops up on a regular basis as an activist investor.
Yep.
So where will we? What will Pepsi look like? That we're almost out of time. But what will Pepsi you think look like in say 5 years?
I think it's a smaller company. Smaller company because they divested. Probably a smaller company because consumer preferences and tastes have changed. Yeah. This just goes back to the secular trend is a secular trend. They don't have the branding mega advertising moat and the fact that you can block off shelf space at the grocery stores because Pepsi pays for what's known as trade spend, which is you basically are eye level on where in the snack aisle and things like that. Those days are not the same anymore. So I think the important story for Pepsi and why it'll be a smaller company years from now, and that includes the investors, but even if you say they don't do any of that, it'll still be smaller, is because the balkanization of the media landscape has broken Pepsi's structural moat, which was marketing and crowding out the little guy.
That was Dan Rohinton, portfolio manager at IA Global Asset Management. Still ahead, today's market movers with Bloomberg's Matthew Griffin. For some movers south of the border, we are joined now by Bloomberg equities reporter Matthew Griffin. Matthew, thanks as always for joining us.
Thanks for having me.
All right, let's talk Home Depot. Their outlook, not bleak, but cautious, shall we say?
No, it's definitely not as bad as maybe investors' worst fears. We've seen shares of Home Depot, the home improvement retailer, swinging back and forth throughout the day as investors make sense of their outlook. They said that they expect comparable sales to be flat to up 2% next year, but they also have this market rebound scenario where the U.S. housing market improves more than expected and comparable sales could grow more. This sort of mixed message from the company is really an example of what we've seen throughout the home building industry and the housing market this year. You have mortgage rates down, which is a positive for home buyers, but prices are still really high, rates are still high, and consumers are under pressure elsewhere given high prices across the economy. That's weighed on shares of home builders. It's weighed on shares of Home Depot, down about 11% now year to date. And it seems like investors are not treating this forecast as a disaster, but not necessarily giving them the benefit of the doubt today. We've got shares down a little less than 1% right now.
Is there any clear indicator which side of what they're saying we're to believe?
The company does seem to be leaning towards the more cautious outlook that 0% to 2% growth is their preliminary forecast for next year. And their CFO said at their investor day today that they don't see a catalyst for an inflection in the market next year. But it does seem like they want to show that there is potential upside if things improve more quickly than expected.
Okay, CVS, long ailing, is it feeling better?
Yes, CVS has been feeling better this year in general. The stock is now up about 75% year to date. The latest leg higher has come today after the company gave an outlook for next year that was better than expected. CVS, the drugstore company, expects adjusted earnings per share of as much as $7.20 US. Wall Street was only looking for $7.17 US. Also raised guidance for this year. CVS, of course, coming off 3 down years for the stock, including a 43% drop last year. They were facing high costs in their insurance business. They were even weighing breaking the company up last year, brought in a new CEO. This year, things have gone much better, both in terms of their results and investor sentiment. This is definitely seen as a rebound story, not one that is fully accomplished yet. But today, investors are taking this outlook as a positive.
All right, and is it mostly the CEO, the new CEO, getting the credit for all this?
So far, it seems so. Investors do seem happy with their leadership, but it does seem to be a whole company effort. Leerink said today that they see this as a robust recovery story. And I actually think back to when the new CEO came in, the message to employees was, we are all in this together. Let's work together to turn things around at the company. It seems like that's going well so far.
Okay, and is it Aries or Aries? Aries? Aries?
I say Aries.
All right, we'll say Aries today. It's soaring. It's on the S&P 500 now. What'd they do to get there?
Yeah, so Ares private equity company, they won inclusion today in the S&P 500 index. That's effective Thursday, replacing Kellanova. The company simply is, it's been one of the largest U.S. companies not in the index. You have to meet certain requirements for market cap, liquidity, U.S. operations, but it's never a guarantee that you're going to get in. The committee that makes these decisions has to decide it's your moment. And so we've known that Kellanova was set up to leave the index since they agreed to be bought by Mars, but it's always a bit of a guessing game. And today, Ares was the winner of that game. That can be a big deal for a stock. You have more passive investment in funds that track these indexes than ever. And so a lot of people pile into the shares. I would think of other examples from this year, like Robinhood, actually rallied this summer on speculation they get into the index, finally won inclusion in September, had another rally then. And it's happened to other names, Carvana just yesterday. And so Ares, again, sort of the latest winner of this Wall Street game.
And do we know what it's done, like what kind of changes it's made that has brought it up like this?
You know, it's not necessarily that a company has to shift its own operations. There are cases where a company's operations can be an issue. Another company that's talked about a lot as a candidate is Strategy, the Bitcoin treasury company. But there are questions about whether the committee wants to include that investment-focused business model in the index. For Ares, it seems to be a story of, again, the size of the company, their presence in the U.S. economy. It is worth noting, have had a share rebound. Private equity stocks have been volatile this year on credit concerns, interest rates staying high. Ares has recovered and actually now are just about flat on the year after a rally of now almost 8% today.
Okay, we'll leave it there, Matt. Always a pleasure. Thanks for joining us.
Thanks for having me.
That's Bloomberg's Matthew Griffin. And let's take a look at the markets and see what is moving right now. And the TSX, you can see it's up by almost a half a point. And a lot of that is being driven by silver. Yeah, silver companies right now. Silver is hitting record highs. It's up over $60 right now. It's trading over. And so you can see who's benefiting from this. Pan American is up more than 10%. Gold and silver up by 7.7, and First Majestic is up by 6.33. Gold is seeing near record highs everywhere you look with them now. And taking a look at, do we have some of the off stocks for today or no? We do. Look at that. You guys are the best. Thank you. Ivanhoe, Bombardier, and Advantage all seeing dips right now. Ivanhoe off by 3.9. Bombardier 3.3. They just delivered one of their new jets today. You would have thought that would be good news, but maybe people want to see more than that. And a quick peek at the American markets before we go. And you can see a mix of red and green there. That is it for us for Trading Day. Thanks for joining us.